Is everyone here? I mean, is there anyone here? For those who are here, why don't we give a few minutes for whoever who wants to come to enter the webinar? To those who just enter, I'm trying to give a few minutes for those who are entering the webinar for them time to settle down and enter the webinar. I'm sure you guys are expecting to see Cass, but she's on leave for today, so I'll be covering for her. Can you guys hear me? Do say yes in the chat if you can hear me. For those of you who just entered the webinar, I'm trying to give a minute or two to those who are entering the webinar, give them time to enter and settle down, etc., etc. Welcome to the webinar. I'm sure some of you are expecting to see Cass, but as she's on leave today, I'll be covering for her. So as mentioned, let's just give the remaining people who want to enter 1 or 2 minutes. Well then, all right, without further ado, why don't we start the webinar? Welcome to the webinar for those of you who are here. Feel free to ask any questions along the way if there's something you don't understand, or there's something you want to clarify, or there's something you want to explore more. So for today's webinar, we'll be learning about fundamental tools about support and resistance. I'm your presenter for today. I'm Joanne. So first of all, there's a disclaimer actually. So the information, context, and opinions which are expressed in the presentation and on the following slides are solely that of me, the presenter, and not necessarily those of the Vantage, and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. So Vantage does not guarantee the accuracy and reliability of the information provided herein on how a client should trade. Yeah, and there's a risk warning on the trading margin FX and CFDs that carries a significant risk and is not suitable for all investors. You could lose substantially more than your initial investment. When acquiring our derivative product, you have no entitlement, rights, or obligation to the underlying financial asset. So you are kindly advised to read the relevant documents on the Vantage legal document page and seek independent advice to fully understand the risks before deciding to trade. Information is of a general nature only and does not consider your financial objectives or personal circumstances. The responsibility for using and or relying on such opinion, material context lies with the client, and Vantage accepts a responsibility for any loss, including without limitation to any loss of profits resulting directly or indirectly from reliance on such information. Attendees should know that sessions are audio recorded and may be published in various media, including print, audio, video format without further notice. And yes, you have the information about the company itself. All right then. So these are the group of analysts, including me, and yeah, our company is the finalist for the Best FX Research during 2019, 2020, 2021, and a finalist for Best Equity Research during 2020 and 2021. All right. So for those of you who weren't here at the beginning, I'll be covering for Cass today. If you're expecting Cass, and I'll be she's on leave. She's on leave. So yep, here I am. So for today's agenda, we'll be talking about swing highs, swing lows, the psychology of pullback support resistance, the horizontal overlap, and combining different studies. So first, let's do off into the swing highs or swing lows. So the right way, this shows a significant swing and shows the right way to identify a swing high or a swing low. So you can see from the GIF here. You can see my mouse. Okay, great. You can see my mouse. So basically, you can see this is a swing high. It's a big swing high. It's a significant swing high. And you can see from afterwards, it's a swing low, big swing low. Again, a big swing high. Look at the drawings. Yep. So these are big swing highs and swing lows, significant swings, highs and lows. These are the swing highs and swing lows that you guys will want to use in your analysis. Then there's a wrong way, which is the insignificant swing high and swing lows. So these are bad for you to use for your Fibonacci points, for your resistance support level, for your entry level. These are all bad points to use. So do not use them. You can see from the GIF there. So look at this tiny, insignificant swing high, swing lows. Yeah, don't use them basically. So then now we have single swings. Let's talk about in under significant we have single swings. So you see, this is considered a single swing and this is considered single swings. So you can denote your resistance here and then your support there also, yeah. So so this recent significant swing high and lows can be, you can use it to highlight, to showcase your resistance and support, but the thing is they are not very strong. Yeah. Now you have multiple swings. So unlike your single swings, these are your multiple swings. So notice there's multiple swing highs here. So the thing is you should look how far your resistance and support can go. So you can cut through small wicks. So since your support and resistance level is like a zone, it's an area, but it's not a single level thing. So notice how the GIF is cutting through the levels, cutting through the wicks to form a zone, multiple swing highs, right? So yeah, so this is a strong with multiple swing, this is a strong swing swing high. So let's make this more interactive, and maybe I'll show you guys in a chart. All right. Okay, I brought up my chart. So okay, so what's the example of a significant swing high and swing low? Maybe we can look at the chart and maybe we study the chart. So okay. All right, so you can see this is an example of a significant swing low. Yeah, it's significant. Oops. And we have another significant swing low here. Right here. See, significant swing low. This is significant. So now that you've seen the significant, maybe you can look at insignificant. So you can see like this, there are some insignificant swing along. Let's look along upon this area here. So insignificant could be something like this. Here. You can see there's a very insignificant swing high there. So even though there's a swing high, it is insignificant and shouldn't be used for your retracement, your levels. Yep, don't use them. So other examples would include maybe here, insignificant, areas like this basically. I'm wondering maybe can we see like a, yeah, as a, can see like a, okay, this is also an example of a single swing lower. They can maybe put support here. Yeah, example. So it's a single swing low, but we can make it stronger. We can look for maybe multiple swing highs or swing lows. Let's try to look for one. Okay, maybe let's find another chart. Okay. Okay, here's a question. Is this a significant swing low? What do you guys think? Do you think what I have circled is a significant swing low? Yep. Yep. To us answer yes. Yep. Yep. It's a significant swing low here. So how about how about this one? Let's say the chart was here. Can I use this as any of my levels? Do you or any of my retracement or Fibonacci retracement or anything? No, that's correct. Yep. So because the thing is, this is not significant now. So okay, now that we are here, why don't we look for multiple swing highs and lows? Doesn't seem like there is. Can't find one. Again, we can see, oh, this one here. So you see, a swing low that is significant, another swing low that is significant. Now, this can become a multiple swing low. Well, okay, it couldn't reach, but if the wick was a bit longer, and if the wick was a bit longer, yeah, we could have a multiple swing low here, basically. So this will make this into a stronger swing low. And if you draw like a support level there, it'll be a stronger support level which you can use. Okay, so maybe so I highlighted some stuff on the chart. Why don't we go back to the slides and let's continue. All right, so now that you guys see the multiple swing highs, multiple swing low, multiple swing, significant swing, and significant swing. Yeah, let's move on. So let's talk about the psychology of the pullback. So first, let's talk about the pullback support. So what is the pullback support? So if you notice, right, in this area here, we have a reversing of the price, right? So we have a reversing of the price here, we have a reversing of the price here, we have another reversing of the price here, and then we reach here, right? So what traders would expect is basically price to reverse again. So but the thing is it doesn't. So it actually breaks through the resistance level, goes up. So what the guys do, or what do people do? So the traders who will then hold on to it, and when it comes down here, so they will close the position. Yep, they'll close the position here, and they close the position through a buyer here, and then we continue from here. So this is the pullback, the pullback support. So this acts as the support, this zone here. It's not like a line, it's a zone. Yeah. We can show some examples of it in the chart later. So now we have the pullback resistance. So it's the inverse of the scenario just now. So we have like a bouncing this time instead of reversing. So it's like a sell, bounce, yeah, a bounce here as well. 3 bounces. So when the price gets to here, the investors, the traders expect a bounce as well, but no, it doesn't bounce. It goes down. So when it goes down, again, hold on to the position. Don't close the position. Then you close the position here through a sell. I mean, here's like a buy as it bounces, and then here is a sell. I misspoke just now. So it's a buy, and a sell. So you close the position through a sell here, as it reverses off the resistance zone here. So it was a support here, and there's a resistance down here. So as it reverses off, so this is our pullback resistance, where it reverses off the resistance zone. Yeah. So you're closing position through a sell. So that's a psychology of another pullback here. It's the inverse on just now one. So you can have a GIF here to show you. Okay, so here's interesting. So actually, what's happening is this confluence of things happening here. There's also a Fibonacci confluence. See, notice there's 2 Fibonacci levels here. I found 2 Fibonacci retracement here. So it's created. So what do you think goes there? What happens when it goes there? It reverses. So this is a perfect step-by-step, case-by-case, step-by-step example of what I shown just now here. Oops, yeah, here. Here. Nice. Here. So as you see, price breaks through the support level, and then is a pullback resistance. So this previously support level acts as a resistance now, and it reverses across it. So you can look at it. So, yep. So that's your zone. You're creating a pullback resistance zone, right? So you have the 2 Fibonacci retracement to create a zone. Zone is created, and it reverses off the zone. Okay. Well, let's go back to first. So now that you have the pullback resistance, again, let's plot the chart. Let's see if we can find any of the pullback resistance. Oops. Any of the pullback resistance. Nope. Let's look at our previous forex pair. Okay, I think maybe we could have a instead of a pullback resistance, we could have a pullback support here. I think can be found here. So notice the swing highs here, swing low here. Okay, so first we have the All right. So basically, what happens is basically you see there's a swing highs here, and then you form the a resistance here. So you have a resistance level at your swing high, which is perfectly fine. But as the charts continue, okay, so around this part area, yeah, before this candle. So before this, you're expecting like price to reverse off this resistance level, but the thing is, it doesn't. It progresses on. It breaks the resistance level. So it breaks the resistance level. So now what happens in our pullback support? It goes down. And you see, it goes down and it bounces off. So this becomes our pullback support. So this is how you can use the information you have learned here into your own trading, into your charts. So you see, this can become your pullback support. So we can make it. We can create a confluence by adding more maybe things like Fibonacci retracement to it, etc., etc. So why don't we see if we can add something to it? So if we do something like this. Okay, no, this one doesn't really work. So you see, I did a projection like this. So imagine if the price was somewhere around here. So I did a projection here like this. Let's say at this point of time, I did a projection here. And then so we have this pullback support here. So what I'm thinking is actually the price is going to bounce off here. So I have that bias. So now when I play it, see, it exactly happens. Pullback support happens right over here. Bounces off. So you have here, here, here. So you have your cells, and then to close your sell position, because over here at this point, oh no, price breakthrough, it doesn't reverse. So you wait your psychology of pullback, and it goes here, and then you buy to close the position, and ta-da, it bounces off. Yep. So this is how the pullback support works. Oops. Any other example? Okay, let's look for. All right, one more thing before I didn't mention this now. So one thing you guys might have noticed, these are all significant swing highs and swing lows that I'm using. So you add on to the previous information that you guys have learned just now. Let's see if we can find some more. Okay, sometimes you can't find someone, but I can't find another one, another example, but that's all right. I'm sure you guys had the idea behind. I mean, got the idea behind it already. Let's move on to our other slides, our other components, our slides. If there's time, maybe you can come back and I can show you. Can actually find more examples. Okay, so moving on from the psychology of pullback, we have the overlap support and resistance thing. So, okay, overlap support. So notice how, I mean, I study the diagram for a while, study the chart for a while. Look at the trend. So you have the overlap support here. I mean the pullback support. Yeah. Example, yeah, see pullback support. But the point I'm trying to make here is basically, you see, okay, so there's a big swing high resistance here, and then when it passes through the swing high resistance, it becomes a pullback support, and the price also has made a pullback to your pullback support level here, and you see it bounces off perfectly, and once the price bounces off, this becomes an overlap support. So why is it an overlap support? The overlap support is because there's a swing high and a swing low on it. So it becomes overlap support. So it doesn't have to be a swing high, swing low. It can be two swing highs and two swing lows. Okay, you guys done with the chart. Now let's show you the GIF. So you can see from the GIF, right? Swing high. So I mean, two is a swing high and one is a swing low. It creates this overlap, resistance level. Now that the price is here. So you see this point, you expect price to reverse off from this strong resistance level, strong overlap resistance level, and it goes up. Okay, yeah. So that's an example of overlap support that became an overlap resistance afterwards. Let's see, you can write. Okay, good. There's nothing else. Let's go back to the chart and start searching for examples again. Okay, I used this example just now, but maybe show again. So what is exactly touching? So just for the sake of the lesson, just imagine the wick was just touching this level. Yeah, imagine it was touching the level. Okay, so now we have an overlap level here. So we have the swing high touching it and the swing low touching it. Yep. So that's how you create an overlap support. Now that the price is here, it's overlap support. Okay, why don't we look for more examples? Hmm. Okay. So let us imagine the chart was maybe here. So what happens actually? It doesn't have to be a swing high, swing low. It can be two swing highs and two swing lows. The key is two. So one of each. One swing high, one swing low, two swing highs, three swing lows. So now if you look over here, actually we have one swing low here, another swing low here, two swing lows. So this makes it become an overlap level, overlap support right now. I'm not sure if price respects this. Let's see if price respects this. Oh, you see, it does respect this. Although it breaks through now, and now this. So you see, price respects this. This is insignificant swing low, but you can see that price bounces off this overlap support. And now although it has broken through this overlap support now this is becomes a pullback resistance. So price goes up. Let's see what happens. Okay, while price broke through this, right? Okay, price may have broken through this, but it's important to know that price did respect this over here. So what you guys should always do is always try to find stronger levels. Price may still, I mean, price may and will break through in the future, but if you find a stronger level, the stronger your analysis can hold. All right. See if you can find more examples. An example of a swing high right here. See, look at this. Price, an example here. Price reverses off here, price reverses off here. Overlap is formed, two swing highs there. So it becomes a resistance level that is stronger. Overlap resistance level if let's say price was here. Overlap resistance level right here. So it becomes this, the overlap support, my bad. So it becomes an overlap support here because of the two swing highs previously. And then when you actually play it, you can see that price reverses off it. So while eventually your levels can get broken through, but you see, if you notice here, bounces off, it's insignificant. But see, it bounces off. So this highlights the importance of having an overlap resistance or overlap support. Remember, two swing highs or two swing lows or one swing high or one swing low. The keyword is two. Okay. Now let's move on to our next part of our webinar, combining the different studies. So when you combine different studies, it becomes a confluence. So okay, right here, what do we have here? Let's look at this diagram, this chart, and let's analyze it together. So basically, you can see from here, one swing low here, right here. You guys can see my mouse, right? And another swing low here, two swing lows, and then overlap. This becomes an overlap level. So not if price is here as it is right now, becomes overlap resistance. So what and also the reason why it's confluence is because you add other things. So you can see also adds a Ichimoku cloud here. You can see the Ichimoku cloud. So when price is below the Ichimoku cloud, it's a sell signal. It's a you have a bearish bias basically. So okay, price goes up. What do you expect? Remember, overlap resistance plus Ichimoku cloud is below the Ichimoku cloud, and it's at the Ichimoku cloud. So actually, Ichimoku cloud can also act as a resistance. So you expect it to reverse off the Ichimoku cloud, and as well as the overlap resistance level. So this is what you expect, and I don't think I have the I don't have the next picture, but basically what happens is reverse. So it reverse from the not only the Ichimoku cloud, Ichimoku resistance, it also reverse from the overlap resistance. So maybe you can look at this in action in the interactive charts. Let's So you guys remember if we found this one just now? So okay, Ishimoku doesn't work here, but can combine different elements, maybe let's say RSI or something. Okay. Okay. I think Stoke gives us a good view of what happens. All right. So what happens is basically we have our overlap support here. I mean, it's pullback support, but it becomes overlap support later. But now we have a pullback support, overlap level. You see, yeah, two swing highs and everything. All right. So basically, what happens here is can use our Stoke. So for our stochastic indicator, basically what happens is basically we expect price to bounce off the stochastic support. So now, this is an example of a confluence where we combine different elements of technical analysis together. Okay, so if you guys paid attention just now, you guys will know what happens. So you see, okay. So what happens is basically the price. You see, as you guys record, it bounces off the overlap support, and also at the stochastic indicator. Our stochastic indicator also shows the same thing, where we expect price to bounce off the stochastic support, and it did. So this is one example of combining different elements together, as you guys have seen in the like this example. This example use Ichimoku and the overlap resistance here. But for our interval example, we are using stochastic and the overlap support here. So this is example of a confluence combining different things together. I have a question on so whether I use SMA. So I used SMA before, but just but if you are wondering whether is it good or not, SMA alone is not enough. So you need other indicators or other on-chart indicators, off-chart indicators, on-chart drawings, on-chart calculations, things like that. Combining things together, this is the only way to make a technical analysis strong. So, yep, we have an example here. And let's look for more examples. Okay. So we have the okay, example of maybe copper thing. Oh, copper's not really there. Nice to show an example. Is it? Could I find something? Well, okay, maybe I can just show you guys maybe a confluence of things that are happening. Basically, maybe that's better. So this so remember the first part of my webinar was about the significant swing high, swing low. So yeah, so this is an example of a significant swing low. Another example. So while you can put your maybe your okay, this is a resistance level, in this case since price over there, you can put it there. It is not strong. So ideally we like to find multiple swing highs or swing low, multiple swing highs or swing lows. So we can instead of, so this is a pullback. Instead of making a pullback, if there's, let's say there's another one, you can try to pull it back and see whether there's another one. Okay, great. I think we got another swing low here. It's a bit wide to see, but yeah. Okay, so we have another swing low here. So okay, so like what happens is basically we expect, like, let's say price goes around here, maybe you can reverse off here or something. Yeah, maybe. So how we create a confluence, basically we combine elements together. um but this thing haven't played out, so maybe we can't see it, but okay, maybe you can try it here. Didn't really respect the level, but so it's like a game probability. So basically um you're hoping that with a stronger level, there's a higher chance that the price will respect the level. Well, it didn't really respect this in this case. I mean, it did for some. Okay, but this is not a good example. Try to find something else. Okay, let's see what else we just there. So, example of oh no, it didn't connect. Wait, does it? Oh, I found this was way longer. But if this was longer, yeah, this is an example of a two swing low creating a overlap. Overlap. If price is here, it becomes overlap support. let's see, yeah, here. But the thing is, you see, this problem with a single swing high or swing low is a single swing high or swing low is not strong enough. It can clearly be seen here. So it breaks through. Right? It doesn't really respect the levels. So that's the issue using a single swing high, swing low. So what you're trying to do is basically make your levels stronger and stronger. Maybe multiple swing highs, multiple swing lows, overlap resistance, overlap support, and then you combine that with Fibonacci levels, create a zone, make it more stronger. Use indicators as a confirmation, make it even stronger. Yep, and that's really how you proceed with your technical analysis. Oh, another question. So if I use SMA, which days you set 10, 20, or 50? Okay. So what I found about SMA is basically like every trader they have their own bias basically on which days they set and everything. So depending on your on your what kind of trader you are, example maybe like swing traders, scalper, etc., and then you can decide on which days of SMA is is the best fit for you. And also there's also other factors involved on what kind of trader you are. So this goes under your trading plan actually. So okay, now that we know this, could we really not find anything here? Okay. Oh, that's great. So if another example, two swing lows, and this become a great this will be a great overlap resistance if price went like this. Yeah, then we will expect price to reverse off here. Does it? Oh shoot. Does it? Okay, it hasn't. But let's say price went down. Yep, and this will be a good example to really showcase the overlap resistance. So why don't I just recap what we are talking about? So to recap what we are talking about, basically, first thing is the significant swings. Significant swing high, swing lows. It needs to be your swing high, swing lows, whether you want to use it as a level, you want to use it as a retracement, Fibonacci retracement, etc. You want to do it the right way. You want it to be significant. Don't use insignificant points. Single swings are okay to use, but it's not very strong. Try to use multiple swings if possible. Psychology of pullback. So it becomes a pullback support once the price breaks through the resistance level. Same thing for is the inverse for the pullback resistance. Overlap support. Basically two swing highs, two swing lows, or swing high and swing low. It becomes a overlap support. Once price, let's say price is above the level, it's the other way around. If it's you want to overlap resistance, and we can combine different components like indicator, in this case an indicator, and overlap resistance to make a level stronger and to increase to make your bias stronger as well. If whether you think it's this is a bearish bias. So I hope that you guys have learned something from the lecture today, and thank you for attending the lecture, the webinar.